So books. When you buy an option, the reason that I think it's a better play to find options to buy rather than options to sell is because of your risk. So when you're buying an option, you know the exact amount of risk. Okay? So books, January 31, and as an example, if I buy 10 of these for 25 cents, I have $250 of risk, and I can never lose more. So for me, I think that Barnes & Nobles will eventually be bought out. Once I have that opinion, and they are shopping the business around, without a doubt, in the conference call, they said they are shopping the business to a potential buyer. I think that they're going to get bought out. Maybe they get bought out from Amazon. Maybe they get bought out from Starbucks. I don't know. If they do get bought out, I think they'll get bought out for $12, $13, $14. So when I'm doing a trade like books, I want to be a buyer. I want to find out how much money am I comfortable risking. And once I figure that out, that's how I'll back into a trade. So if we look at books, and right now books is trading 645. Now the trade that I like, the reason why I'm in the trade, the reason why I shared the trade on the week ahead is because potential buyout. Now, if I'm right, we might trade to 12 to 13 to 14. If I'm wrong, which I could be, absolutely, you have to understand that trying to speculate on a stock getting bought out is not a high probability play, right? I mean, it's not like a 90% play. I don't know what percentage it is, but it's certainly not 90%. For a trade like this, I want you to, what's your risk? So before you get into the trade, think about, okay, Jonathan just shared this idea. It's kind of cool. It kind of resonates with me. I kind of agree with it. What do I want to do? So if we pull up books and we go out to March, and let's say, the market's been getting tattooed lately, so everything is down along with the books position, but we still have 87 days. Within that 87 days, mind you, we're also most likely going to have an earnings announcement. Very cool. So once you decide what your risk is, and in this example, let's say that we're comfortable risking $1,000, okay? We want to risk $1,000. So if we're comfortable in this example risking $1,000, you could buy the 7 strike call for 55 cents. So we want to buy 7 strike for 50 cents. What I would suggest and how I teach and why this is a process, okay, I've trained over 100 professional traders. I've done this a lot. I've seen what works. I see what doesn't work. What I would suggest in a trade like this is buy the 7 strike calls for 50 cents, but buy, how many should we buy? Let's buy 7 of them. Let's do it 7 times. So 7 times 50 cents is going to be $350. Okay? So 350 out of the 1,000. So now we have 650 left that we still can play, that we could still ladder into the trade. Because if books is trading at 645, which is right here, and it goes up and it goes down to 530, we want to be a buyer. We want to be a buyer, especially if it goes down because the overall market's down 500 points or 1,000 points. So it's just getting dragged down. Because the fact remains that they're still shopping the business around, right? You guys probably had a Barnes & Noble by you, and there's probably not one there now. We still have a Barnes & Noble in our town. There's a Starbucks inside. The Starbucks has to be doing more business than the Barnes & Noble's business, than the Barnes & Noble's doing. So we want to ladder into that trade. So the great thing about buying options rather than selling options is you know without a doubt what your risk is. And you make that decision before you get into the trade. Okay? Now, if we wanted to risk $1,000 doing a credit spread and we think that books is going higher, we could sell the 6s and buy the 5s, right? 55 cents and 20 cents. We would have $1,000 of risk, but our reward is buying the 55, selling them for 20 cents. We make $350, but our risk is $1,000. Okay? So if we do a credit spread, we risk 1K to make 350 in the 6-5 credit spread. If they do get bought out and it trades 13, we profit $350 on $1,000 of risk. Not a bad trade. You make some money, right? But if you use that $1,000 and buy 20 for 50 cents, you're going to have 1,000 of risk. And what do you make? What do you make? I'm going to be faster than all you because I want to keep it moving. Anybody want to throw it in there? What do you make? We're long 20 of the 7 strike calls and books. It goes up to 13. What do we make? Thank you, Brian. You would make 13 minus 7, which equals 6. Since we have 20 options, that's 2,000 shares of stock. Okay, 2,000 equals 12,000 minus 1,000 equals 11K. So the answer, why would I suggest calls, or rather, why would I want to buy calls rather than do a credit spread, is because for this specific trade, I want to risk 1,000 to make 11,000. I do not want to risk 1,000 to make $350. Okay? QRTEA is different. For that one, I wanted to do a credit spread because I just felt that that would take a longer time to play out. Whenever you're buying options, you need to have a catalyst. A catalyst. It's a reason for that stock to move. So overall, the takeaway, the lesson from this is books. You need to answer the question, how much do you want to risk? Okay? So before you do any trade, answer the question, how much do I want to risk? And too many people will come to me and talk about getting long a stock with a stop, and just saying that stop is used for locking in their risk, right? They only want to lose $1,000, so they put their stop at 1,000. But then the market starts moving, and they're going to get some slippage on their stop, and maybe they end up losing a lot more than $1,000. Or Who's ever put some trades on and put a stop in the market, and then the market gets close and they start playing around and trying to get cute, so they take the stop out of the market? Nobody's ever done that, right? Of course, we all do that. Everyone does that.